what stocks you can purchase in terms of hedging yourself or protecting yourself to an extent against inflation. Buy some real estate. Now, I'm not necessarily talking about house, but please remember that your bet can go terribly off. Hi everyone, welcome to today's video. So let me start today's video by showing you some very interesting data about inflation. So back in October of 2021, we were hitting an inflation of 4.5% in India. Right now, that inflation number is roughly 8%. So the inflation has almost 2x'd within a span of few months. Same is the situation in the US and same is the situation all across the globe, that the world is struggling to fight with inflation. As a result, what the governments are doing is that the US Feds have been increasing interest rates, and it is expected that this year they are going to undertake 5 interest rate hikes. Indian government also, or RBI precisely, has been increasing the interest rate. They increased the interest rate prematurely earlier this month, and it is expected that in June also they are going to increase the interest rate. So every time the interest rates are increased, the crypto market falls, the stock market falls, and people start panicking that Akshat lut gaye, barbad ho gaye, now we will never be able to get back in the stock market, etc, etc. So first and foremost, very important message that the US stock index, I'm not talking about individual stocks, US stock index have fallen by 15%. Indian Nifty has fallen by roughly 14% over the last 6 months. These are big falls in the indices. If you see your portfolio in red, please do not panic. It is a basic common sense that there are years when you will be making a lot of gains. For example, 2020 to middle of 2021, people made insane amount of returns, and over the last 1 year, the returns have gone down. It's cyclical. Stock market is also cyclical. That's the only thing that I can say as a rational investor. And think about it yourself, that right now you have two options. Option one is that you will sit on cash and do nothing. In that event, you are losing. 100% you are losing due to high inflation. Option two is that you take risk, you invest. In that scenario also, there can be short-term pain. So which of these options will you pick? 100% loss guaranteed, or more volatility, more chances of loss, but also more chances of return? The choice is yours, and accordingly, you will need to take bets. So on this video, I'm going to talk about 6 key options that you can explore in terms of handling inflation. Now, are you guaranteed to make returns on these options that I'm talking about? No, but historically speaking, looking at the data, these 6 options can be a good bet to hedge against your risk that come with high inflation. So I will talk about 6 options that can help you somewhat profit from inflation. So before speaking about these 6 options, I would like to briefly touch upon the theoretical aspect of inflation and how many types of inflation are there. If you understand this basic economics, it will help you understand what is happening in the world, and you will not panic whenever you see these type of falls and situations. So there are 3 types of inflation that is there, and I will give you a very quick, easy to understand explanation. So first is called as demand pull inflation. In simple words, it means that the demand of things has risen temporarily, but the supply has not risen. So think about it this way, that India has the capacity to produce only 1 million shampoo bottles every year. Now suddenly there is a surge in demand, that instead of 1 million demand of shampoo, there is 2 million demand of shampoo. So as a result, because the demand has gone up, the prices too will rise, and that will lead to something called as demand pull inflation. So this is something that we witnessed in the early part of 2020, that a lot of factories shut down due to COVID problem and supply took a hit. And people started hoarding also. And there was a lot of increased demand of things also. So this situation primarily is persisting even now. Why? Because there has been a lot of quantitative easing, printing of money and dumping it onto the economy. That still exists. A lot of free money still exists in the economy. And as a result, the demand has not come down. So this inflation is still going on. Second is something called as cost push inflation. It simply means that the input cost of things are becoming higher. This happens due to supply chain disruptions predominantly. Due to Russia-Ukraine crisis, supply chain disruption has happened in the world, and it is leading to very high cost push inflation. The third type of inflation is called as built-in inflation. It happens when people start demanding higher salaries. So you might have noticed that very recently, a lot of IT companies saw a very high rate of attrition, and that was primarily because of the fact that people demanded higher salaries and they were getting those salaries with startups. So right now, the interesting part is that we are witnessing all these 3 different types of inflation that is impacting the economy. When you ask people around that what is their outlook on the economy, there is a lot of confusion going around because in 2022, we are witnessing a confluence of all three different types of inflation. So the word of the day today is confluence. Let me know what does that mean. So with that said, let us start discussing 6 simple options through which you can somewhat protect yourself against inflation. Is it a guarantee of returns? Absolutely not, because if the entire world is going down and irrespective of which asset you are investing in, you will still take a hit. You will still take a loss. And also remember the key point that if you are just keeping your money in the bank account, you are still taking a loss. You are not seeing that loss. That's the only thing. So option 1 is that if you have any kind of debt, please pay it. So pay your debt. If you have student loan, if you have housing loan, if you have etc. loan, please pay it and get done with it. Why? Because any form of cash right now is the worst form of investment that you can make at this juncture. Why is that? Because during high inflation period, what does high inflation period indicates? It indicates that your money is getting depleted by that same amount. If the inflation is 8%, it simply means that keep 100 rupees in your bank account, you will get 2% savings rate. 8% is the inflation. So net, you are losing 6%. And your 100 rupee becomes 94 rupees. So if you have debt to pay anyone, please pay it. If you have taken udhar from your friends, pay them. It will become their headache how they will spend that money now. In fact, this is the same roadmap that a lot of corporates undertook. You might have seen that in the last 1 year, a lot of corporate firms have been repaying their debt. Why is that? Because holding a lot of cash might be a losing proposition. So a lot of companies that raised money, they ended up repaying their debt. And this is the same roadmap that you should also follow, that if you have any kind of debt, please repay it and be done with it. The second option to protect yourself from inflation would be to buy some real estate. Now, I'm not necessarily talking about house. If you can buy a commercial real estate or agricultural land, that will be an interesting option. Why am I saying it? Because think about it this way, that every quarter, the interest rates are being increased. Now, if interest rates are increased, what does that mean? It simply means that the housing loan becomes more expensive, or any type of loan that you are taking, whether to buy a commercial property or if you can procure it for an agricultural land, etc., it also becomes expensive. So what will happen is that there will be fewer people who will be availing these type of loans going forward, at least in the next year or so. But the number of commercial properties and agricultural land, they remain the same. It's not as if that the numbers are coming down or some property will get automatically vanished because interest rates are high. No, the supply of property remains somewhat the same, but the demand of property will come down as the interest rate keeps on going up. So the important point to note is that if you're looking to buy any property, then you must prefer a floating interest rate over a fixed interest rate as of now. I will also explain you the rationale behind it, but very quickly, let us understand the difference between fixed and floating interest rate. Fixed interest rate means that if a bank gives you an interest rate of 7% for a period of 30 years, then they will be charging a 7% fixed interest rate for those 30 years. A floating interest rate, on the other hand, means that the interest rates are adjusted as per the increase or decrease in inflation. So since right now the inflation is very high and going forward the inflation is likely to come down, therefore if you take a floating interest rate, you are slightly better off. Now, of course, this is a much more complex topic. In case you want, I'll make a separate video on this topic, but I just wanted to give you a very high level summary as to what a sensible argument here economically might be. Now, the third way of protecting yourself against inflation is that you bet on some commodities that you feel comfortable betting on. But please remember that your bet can go terribly off. So let me explain this point by using a few examples. So let us pick the example of Adani Wilmar, and you must have seen that Adani Wilmar went from approximately 340 rupees to all the way to 850 rupees, and then it started correcting. Now, why did it go up? Because everyone was playing with the edible oil cycle. Edible oil is a commodity. There was a recent shortage of edible oil, and everyone thought that, you know what, Adani Wilmar is going to become like a massive rocket and it will forever continue to go up. But that did not play out. Why? Because the edible oil supply crunch somewhat ended to a very large extent. So same thing happened in Oil India Limited also, that back in December or towards the end of the year when Russia-Ukraine crisis started to accelerate, what happened was that Oil India Limited grew from all the way to approximately 175 all the way to 250. So this was a massive jump, and since then the stock has corrected and it has come down in the last 1 month itself by roughly 7%. So this was again an oil cycle at play. These type of commodity cycles keep on going up and down. So now you would say that, okay, this is like a fun exercise. If we can just predict the commodities where some kind of crunch will happen, just invest in stocks that deal with those commodities and get super rich. Yeah, so two problems. So problem number one is that it is almost impossible to predict the commodity cycles. So consider, for example, the auto industry, and if you see the last 5 years, the auto industry has barely moved. There are equal number of vehicles that got sold in 2017 and almost same number of vehicles are getting sold in 2022. So this is a big problem and it reflects in the performance of some of the leading automobile players in India. Consider, for example, Maruti, that in the last 5 years, Maruti stock has given only 5% return. And here we are talking about a leading automobile player in India. If you were trying to time the cycle of how many automobiles will get sold in India, you would have had a very tough time predicting that move also. And this is something that we get to see on everyday basis. We get stuck in traffic all the time. And here we are not even able to predict the sales volume of automobiles. So how will we be able to predict the supply or demand volume of different commodities? But if you say that, okay, you know what, I want to play around with commodity stocks and do tell me your two favorite commodities, then I would say that I'm bullish on steel as of now. And second, I'm bullish on palladium. So why is that? If you want, I'll make a separate video. But if I have to pick two commodities that I'm somewhat bullish about at this stage, it would be palladium and it would be steel. Separate video on that, just let me know. Now comes the fourth option of saving yourself from inflation, which is to invest in government-linked inflation-adjusted bonds. Now these are called as TIPS in the US and these are Treasury Inflation Protection Securities. These are essentially government bonds. So basically when you are going and investing in stocks, stocks are equities. Now bond are a completely different market altogether. Commercial players like ITC, HDFC, they also issue their bonds and government also issues their bonds. So in the US, this TIPS bonds are issued by the US government. And if you're worried that there will be high inflation in the economy, then you can go and buy TIPS based ETFs in the US. For example, ProShare Inflation Expectation ETF is another ETF that you could purchase in the US, which will give you somewhat of an inflation hedge. So such an option doesn't exist in India. So interestingly, in 2013, RBI experimented with these categories of inflation adjusted bonds. So they launched something called as Inflation Index NSS, and these were instruments that used to give returns adjusted to inflation that was existing in India. But unfortunately, that experiment did not gain a lot of traction because a majority of the corporate investors were not interested in buying those bonds. So as a result, the RBI is still mulling whether to launch the next series of those bonds. Bonds that were launched in 2013, they are still active. I don't think that they are traded on a secondary exchange. So therefore, you will have to go to the US in case you are interested in investing in government-backed ETFs, which are inflation protected. Now comes the fifth option of saving yourself from inflation. It is very simple, that you try to earn in US dollars. Now you'd say, why? What's the benefit? Okay, so you need to understand the fact that INR is losing its value by 4% every year compared to US dollars. Yes, earning in USD also might not save you from inflation simply because of the fact that the inflation in the US is still quite high. But the bottom line is that if you are only earning in INR, then it might become an even greater problem for you. So try to earn in US dollar. I had made a separate video explaining some of the paths that you can use in order to earn in US dollars. This is especially important now because the IMF forecast tells us by 2028, one US dollar will roughly become 95 rupees, which is going to be a huge fall for INR. So if you can figure out ways to invest in the US and make money from it, that can give you some hedging against this falling INR. In case you want a separate video, I'll make a separate video on this falling INR as well. That will hopefully give you more clarity. Now coming to sixth and final option of what stocks you can purchase in terms of hedging yourself or protecting yourself to an extent against inflation, then this section is going to be very relevant for you. But before talking about some important stocks here, let me give you a very quick theory around it. This is a very important historic data. So what you would notice is that between 2002, when the dot-com crash ended, and 2008, the value stocks did better than growth stocks. And opposite happened from 2008 to roughly 2022. Now, what is the difference between growth stocks and value stocks? So value stocks are stocks like PepsiCo, Hindustan Unilever, ITC, which are stable cash flow oriented businesses. What are growth stocks? Growth stocks are stocks which are tech driven, which are experimenting on new ideas, where the growth potential is very high, etc., etc. So the important point to note is that it's not as if that all the time growth stocks are better or value stocks are better. There are cycles when value stocks are better, and then there are cycles when growth stocks are better. So the $1 million question right now is that, hey, in the next phase, when this crash is over, this 2020 COVID crash and Russia-Ukraine crash gets over, which of these stocks are going to go higher in valuation and which of these areas you should be betting on. So this brings me to the theory of inflation that I was explaining, that what type of inflation currently are we in. So we are into all types of inflation. There are three primary types and we are into all three types of inflation. But my hypothesis or my prediction going forward is that monopoly based growth stocks and monopoly based value stocks are going to do better. Why is that? This is a theory that I've explained on several of my videos, that the world is getting increasingly monopolized. If you consider the business model of Amazon, it is literally crushing a lot of small distributors. If you consider FMCG companies, then big FMCG companies have very high profit margins and pricing power compared to small players. So the important point or forecast is that going forward, monopoly based growth stocks and monopoly based value stocks are going to do exceedingly well. So what are 3 or 4 key areas that I will point you to? So in order of risk, what I would say is that if you're looking to buy most stable type of stocks as of now, I'm talking as of now, entire market has fallen. So of course, these stocks have also fallen. But the most stable type of monopoly stocks right now would be something like Hindustan Unilever and something like Apple. These have massive brands. The prices that they command are premium prices. And guess what? Even when the inflation problem goes away, these stocks will still stand and they will still command very high premiums in the market. I know I'll get a lot of heat because I'm saying HUL again. I'm bullish about it. I'm not pushing you to invest in it, but please don't expect magic in the next 6 months. If you have conviction in these companies, only then buy it. Otherwise, equity investing itself is not a game where you should be participating. Then please simply do index investing. Please simply do bond investing. Please simply do fixed deposit investing. That might give you better peace of mind. Now, if you want to take a little bit more risk, then I would say that something like Amazon is at a good, sensible buying level. I'm investing in it. Again, not a push from my side to make you invest into it. Now, if you want to invest in even slightly more risky asset, then you could consider investing in slightly growth-oriented stocks. For example, Airbnb is a classic case in point. You could definitely consider that. Travel industry is coming back. Something like Airbnb might have a higher chance of rebounding. But yes, again, not an investment advice. Very risky time for Akshat as a finance influencer there. Now comes the most risky category, and it starts with C and ends with O. You can fill the blanks. And here, I have always advocated that I personally am investing 90% of my money in 2 blue chip cryptos. You know which those 2 blue chip cryptos are. So I will leave the discussion there. And this also comprises of hyper growth assets. For example, it could be companies like UiPath, Coinbase, etc. I'm still very much bullish on it. Can these companies lose 90% of their value also? The answer is yes. These are hyper dangerous companies, no doubt about that. I will link my video below where I have spoken about revealing my portfolio, and I've spoken about the fact that how you should go about taking positions in these hyper growth companies. If you're considering a company like Delta Corp in India, it is a hyper growth company, but it has a very high chances of failure. When you are buying these type of hyper growth companies, you should assume that out of 10 investments that you are making, 7 of them will go to zero, right? You only need 3 of your investment to succeed to make crazy returns. The classic case in point was Amazon back in 2000s, that when the dot-com bubble ended, Amazon lost 90% of its value. But let's imagine that you would have purchased 20 stocks like Amazon, 19 of them went to zero. Would you be sitting at a loss as of now? The answer is no, you would not have. And that is the concept behind investing in hyper growth companies. You can't invest in hyper growth companies and then say that, you know what, I'm not ready to face the volatility. It would not work out. So depending on your risk appetite, I have already suggested 4 tiers. So whichever tier you are comfortable, please go and invest. Please do your own due diligence. That is the most important point. Thank you so much for watching this video, and I will see you tomorrow.